Excellent. Thanks for that, Hannah, and good to meet you all today. Thank you for joining this webinar. So first things first, it'd be great if the webinar can be sort of as interactive as possible. This isn't a webinar I've given before. It's something that Hannah and Francesca asked us to create a few weeks ago, just to give some information to you guys about things you should be considering with your finances, both in terms of how you plan your finances today, but also projecting, looking forwards through short, medium and long term, and how you might be expected to communicate that with your investors. The workshop is going to run over 2 different days. So I think the majority of you are down to be doing this webinar today, with part 2 being tomorrow. So just at the start, I'll briefly run through what we're going to go through today, a bit of background to myself and Dragon Argent, which is the company I work for, and then also I'll give a bit of a brief introduction on what we'll go over tomorrow, just to round off the 2-day course. The webinar's in the calendar for 2 hours. I'd be very surprised if we got anywhere near 2 hours, to be honest, unless you guys are very interactive. Which would be no bad thing, but I think no one really wants to listen to me for 2 hours on this. So I'll go over the key points. I'd expect it'll probably be half an hour to 40 minutes, plenty of time for questions, both as we go through the topics. Feel free to stop me as and when you want to. And also there'll be time for questions at the end, whether that's as a group, or I'll hang back just to answer some individual questions if needs be as well. So all of this webinar will primarily consider your finances and how you look after them, of course. However, what it'll also do is touch upon what we believe to be sort of 10 fundamental key drivers of value to your business. Finances do play a key part in that, obviously, but there are so many other things that you need to be thinking about, which finances have an input into every day when you're running your business. So we'll be touching on all sorts of areas, such as business development, management information, simple things such as ensuring you've got objectives and goals in place that can support the overall vision. Briefly, let me run through who Dragon Argent are. So we're a fairly young business ourselves. Initially, it was run by our managing director, basically as a consultancy business. And around 4 or 5 years ago, bit by bit, we started tagging on core services to be able to help businesses such as the ones you guys are running. Anything from real startups right at the early stage of their growth through SME, all the way into companies which have managed international expansion and sales at values exceeding 100 million. So we really do believe that we can support businesses right from the start of their journey, pretty much through every hurdle and obstacle that they might come to. Our core services, primarily, we're a legal firm. So that covers corporate legal and commercial legal. Corporate legal, within that, considerations which we would help with would be things such as how should your business be structured. I would imagine a lot of you guys today, as with many startups, run technology companies. There'll be software, there'll be IP. So on the legal side, we'd be considering how you're protecting your IP. Is it sufficiently protected? Other things you might come up with are, when you're raising investment, are your shareholders' agreements set up properly to protect you guys as founders? It's all well and good taking on investment, but you've got to protect your own interests as well. On the commercial legal side, we look at contracts with customers, suppliers, and again, as with most things legal, it's all about protecting not only your company's interests, but your interests as founders to make sure that you're deriving the maximum value. we're also accountants. Obviously, that's my role within Dragon Argent. I'm head of accountancy here. And that can cover everything from basic bookkeeping and payroll to other compliance services such as year-end, corporation tax, but also much more value-adding services such as outsourced chief financial officer, for example. At your stage of business, you're unlikely to want to take on a finance director or a CFO, but you might want input from someone who has that experience elsewhere. So we can provide those services to help with financial planning, investor liaison, etc. Other services we provide are advisory, which is general consultancy. This can be anything from EU expansion, board level strategy, corporate finance, employment and HR is something that we do a lot of. Again, as your business grows, one of the main things you want to going to be able to do is hire staff, whether that's on an employed basis or as a subcontractor. You'll need to be able to put agreements in place, incentivize those staff. So we do believe that we have become a one-stop shop for businesses such as your own to really develop, allow you guys to do what you're good at and leave the rest of it to experienced professionals in their sector. We've got a number of external advisors as well. They assist us in more niche areas that we come up against. Examples of that would be data protection, litigation, intellectual property, even to marketing and operations. For example, the deck that has been put together today has been put together by our marketing guy. We can outsource him if you're ever looking for a pitch deck which needs putting together for investors. Then these are all things we can help with. In terms of me individually, my background around 10 years ago in university was in economics. I then moved to London to train as a chartered accountant. I'm now a qualified chartered accountant and chartered tax advisor. I trained at a top 20 firm which specialized in smaller businesses, which I think is actually important in really getting things that keep entrepreneurs awake at night, the struggles that they come up with and how you can help those. The difficulties that you guys face will be infinitely different to the difficulties that larger businesses face. So what I really enjoyed about my training was that I was dealing day to day with entrepreneurs to see exactly what challenges they come up against and how they overcome them. I left my initial firm 2 years ago to move to Dragon Argent to head the client-facing accountancy services. In those 2 years, we're growing quite quickly through a mixture of online marketing, but also just developing networks with hubs such as Enterprise Hub at the Royal Academy of Engineering. The more we get out and speak to you guys, the more we add to our network and the more we can build into our client base by providing useful services to you guys. One of Dragon Argent's taglines in years gone by has been that we believe we're risk aware and not risk averse. And what that means is we're able to look at numbers and look at the accuracy of numbers and legals and really advise you on the best way around your situation, as opposed to simply mitigating the risk for ourselves or you guys, to really try and come up with a solution that adds value to the company, as opposed to just taking the easy risk averse option. What we try to do is drive strategy and value by drawing together from all of our experiences across the legal function and the accountancy function to ensure that we provide very joined up services. What a lot of our clients who come to us have found is that their accountants and their lawyers don't necessarily speak to each other. They don't necessarily give each other advice that really works when you play them off each other. So we make sure that our advice is well-rounded and thought through before providing that to our clients. So moving on to today's workshop, like I said, if you've got any questions at any point, please do just shout up. But today's workshop mostly surrounds why financial planning is required, how you go about modeling that, which is probably a lot more simple than what you might think. And I think one of the key outcomes of today is that in a lot of situations, you do just need to keep it simple and not over concern yourself with numbers and the finances. As long as it's being given consideration, then there's a lot of other things that are a major factor here as well. What tools you might use to go through modeling, identifying and modeling key value drivers, which we'll discuss in quite a lot of depth. What are those key value drivers? They might be slightly different for every business, but by and large, particularly in tech startups, the value is derived from very similar areas every time. And it can become not an entirely one size fits all approach, but we do see the same sort of strengths and weaknesses and pitfalls and opportunities in many of the businesses that we come across as tech startup specialists. We'll also look at modeling scenarios and sensitivities. We'll consider some common pitfalls. And then, as I said, at the end of the session, we'll have some time for any questions that you guys may have that you've not asked during the session. So initially, we'll move on to why financial planning is needed. Oops. So in my opinion, financial planning is required to ensure that you're focusing on the bigger picture. What we see time and time again is entrepreneurs trying to do too much in their own business. And what that can lead to is people running a business but forgetting about that bigger picture. They can get stuck in the weeds with smaller things which aren't necessarily driving the growth of the business. So taking a step back to do some financial planning does make sure that you're focused on the bigger picture and how you're going to get there. It aligns your finances to your business goals, at which your goals could be absolutely anything at this stage. It could be to build revenue and derive profits from those revenues. More likely in the early years, you're going to be loss making, but that's absolutely fine. Revenue can be derived to ensure the growth of your business, to meet certain checkpoints. You might not even be trying to create a new revenue in the early days. It could, and what is very normal for a business such as your own, is it's about developing a concept, a proposition which is somewhat different to the market that can attract attention, not necessarily to sell in the short term, but to attract investment to help you to build further, to keep adding to your valuation as a business. And once you attract that investment, the more you can use the investment to develop your product, the better you will be when you get to revenue generation. So we have a number of clients who it takes them 2-3 years to get to revenue generation. Some of them may never even get there. They can build a sufficient concept that can be bought out by a competitor, and that's their end goal. They don't even ever sell it as a product. So it's important in your early stage to understand what your goals are, and then breaking that down into shorter objectives over the course of the next year, but also possibly even over the next month, the next 2 months, and making sure that there's an alignment between what you're doing as your day-to-day activity and what your objectives are in the short term, what your goals are in the medium term, and ultimately your vision for where the company ends up years down the line. So financial planning, I think, is needed to be able to really nail down what those goals are and understand how you get there in terms of budgeting, spend control, cash flow management, and all that sort of stuff. It helps you manage the inputs to be able to create your desired output. A couple of the things that are mentioned on this checklist is increasing valuation and avoiding over dilution. So one of the main ways to quickly drive the growth of a business will be to get external investment. A lot of entrepreneurs are slightly against this to start with because it's appealing to own 100% of your business. But on the flip side, if you can give away 10% of your business and have someone invest, say, £200,000 for that, the output you might get from that £200,000 will definitely speed up your growth, or it definitely should do. So what you want to do early on with your financial planning is to be able to create a picture that you can communicate with investors. Investors will want to see many things from you as a small business, and obviously one of those being the concept and almost the integrity of you as an individual and the credibility of both your business and you individually. But one other thing they'll want to see is that you have thought out about a financial plan. How are you going to spend their funds? Why do you need the investment? Ensuring that you're well on top of the assets and liabilities that you have as a company. These are quite simple things to manage that if investors think you can't manage them properly, it will really detract from you as an investment possibility for the investor. And just wanting to ensure that you provide the best picture of credibility for your business, essentially. The more you can increase the valuation through providing that credibility, the less percentage of the business you need to give away to ensure that you're raising enough investment to take you to the next stage. So all of these things are fairly key in terms of ensuring that you have enough potential to build your business as quickly as you can. And attracting investment is a key method of doing that. Another reason you'll want to consider your finances and financial planning in detail is to ensure that you're aware of any liabilities before they fall due. One example would be, as a revenue generating business, you could be subject to VAT. You might have a VAT liability every quarter. It's not ideal as a business if you don't see these liabilities coming. If you don't know when you've got to pay your staff or when other large pieces of expenditure might arise, quarterly rent being another one. If you don't really have a plan of when cash is going to go out, then what you can find is suddenly you're just hoping for the best. Your cash can dwindle. You're not spending it in the most efficient way. And ultimately, cash is king to any business. If you run out of cash, then besides you putting blood, sweat and tears into the business yourself, then there's not a lot there which will facilitate the growth of the company. One of our co-directors at Dragon Argent, he used to run a conferencing company, and he ran it from inception to exit, but he fully believes that a lack of attention to financial planning cost him a lot when it came to selling his business, because there were liabilities within that business that he simply wasn't aware of. He hadn't factored it in, and it meant that when he came to sell, there wasn't a great deal of cash left in the business. It put him in a bad position for negotiations, and eventually he sold at what he considered a bottom price for the business and how it was running at that point. So it ensures that you've got control over your finances. It ensures that you're mitigating any risks that might be down the line. And ultimately, for me, that ensures that you can reduce the stress levels of yourself as a business. If you have someone overseeing your finances, or you're capable of doing that yourself, then you know where you're at all times. You know your assets and liabilities. You know how long your cash is going to last. You know where you're going to spend it. And that reduces stress as a business owner because it makes you feel in control of everything. And honestly, as a manager or owner of a small business, then stress relief will become fairly important for you. If things get out of control, then it's going to be impossible to run your business in the most efficient way possible. So all of these things ultimately add to the value of your business. They add to your potential to grow, and they are quite simple outputs of just taking a backseat and looking at your finances, where you are today, where you need to be in 3 months and further down the line, and understanding the inputs that you require to do that. So you obviously need to know exactly what you're going to be modeling. There's no point in pulling together financial models and not really knowing the key aspects of it. As I touched on previously, in my mind, cash is king. We've got a number of clients who seem to occasionally just run themselves into an alley of no return in terms of how they're looking after their cash. They'll raise investment of any amount up to 1-2 million, and they won't plan substantially. They'll have different people who are spending money in a fairly uncontrolled way, and before they know it, their cash has run out. They've not got to the next checkpoint that they want to get to. They find themselves having to go back out for investment and basically be in a terrible negotiation position. They've got creditors who are chasing them for payments. This could be HMRC or various suppliers. And it's all simply because they haven't considered properly how long their cash is going to last. What you need to be considering at this stage of business is how much cash do you have? How much can you find? And that can be find through investment or family and friends, or you might have your own savings, which you're willing to put into the business. But you need to consider how much cash you have, how much you can find, what you're going to spend it on, and crucially, how long it's going to last you. That idea of burn rate, what is the runway of your cash, is so crucial, because then you can know your cash is going to last you a year. So then maybe 6-7 months down the line, you need to be then thinking about, where does the next chunk of cash go? It's generally not a good idea to just run your cash dry and then expect potentially revenues to come into play and help you out from that bottomed out cash position. One of the things we come across supporting SMEs time and time again is everything takes longer than what people think it will initially. If you think your business could generate revenues a year down the line, realistically, it probably won't. You'll encounter difficulties along the way. You'll want to just take your product to the next level before releasing it to the market. So it's always prudent just to have that buffer of a few months cash, or knowing an investor who will put their money into the company again, and just ensuring that you're completely clear on how long your cash will last when you're in the phase of expenditure over revenue. One of the other things that are key, though, is to project sales into the future. I'll touch on this a little bit more tomorrow, but when an investor is looking to put money into the business, not only will they want to know how you're going to spend it, but crucially, they'll want to know what is the return to them. Generally, this will be through growth of the value of your business. And the best way to do that is to take your product to become a commercial success through growing sales. So any investor is going to want to see optimism from you guys in the fact that you're going to be able to sell your product, and you're going to be able to sell it well, and that those sales will increase as time goes on. So having projections which are optimistic is a very good thing, but also they've got to be realistic and built on quite sound underlying principles, which, like I said, we'll touch on that a little bit more tomorrow. But selling an optimistic story is a crucial part of financial modeling, just to ensure that you are bringing in investment to drive the growth of your business. If you're not optimistic about your own financial models and your own projections, then it will be hard to convince an investor to be so. So sales projections are definitely something that you should be modeling. Expenses and budgets, we've touched on slightly. What you might find as you grow your business is you have a number of people, key leaders or stakeholders in the business who are responsible for budgets. A failing we see time and time again is lack of control over spend. People might put X amount towards software production every month and they overspend it every month, and then suddenly they're up to their eyes in debt and they don't have cash to pay it, and their business is really struggling to keep the cash there to keep the business alive. So it's absolutely crucial just to ensure budgets are stuck to, people have responsibility for them, budgets are checked back monthly, any overrun or underrun is analysed, and you ensure you know any reasons for not sticking to your budget and correcting that budget if you need to as you go forward. Break-even analysis is something else which might be key. Revenue generation is all well and good, but investors will probably also want to know when might profits be derived. As an investor, they will hopefully one day expect to receive dividends, and those dividends will have to be derived out of profit. To make profit, you've got to get through the break-even point. So having within your financial model an idea of when you first become revenue generating to the point that you then get to break even, and then further down the line start generating attractive levels of profits is always a good idea, because I'm sure you've all seen Dragon's Den. These are areas that investors want to know about. They want to know when they can expect a return for their cash. They don't just want to give you X amount of hundreds of thousands of pounds just to run it into the ground with no potential return in the medium term. They're always realistic. They know in short term the cash will be spent. Profits are more of a medium to long term thing, but they will want to have some certainty over timings of returns to the investor, and all of this is something that should be built into the financial model. Something else you'll probably be looking to do with investment money is hire into the team. How much will a hire cost? You should be considering what people do you need to bring into the business. Will you need to spend on recruitment fees to bring someone in? Recruitment fees are, in my mind, ridiculously expensive these days, and it's all something that you've got to factor in when considering your model for the next year. Are you going to pay people commission? If you're bringing in someone to sell your product, then they're going to likely want to be incentivized with commissions or bonuses for selling that product. Equally, tech development is a very competitive world, well, in the UK at the moment particularly. How are you going to incentivize these people? If they're high ability people, you're going to want to consider, again, bonuses, potentially golden hellos simply to join. So you do need to think a year down the line. It's all well and good running the business yourself, but you're going to need other expertise to come and join your journey. These people are going to need to be incentivized, and often there's a bit of a cash element to that, to making sure that they are incentivized. We'll touch on other ways of incentivization later in either today's workshop or tomorrow that can avoid the cash burn, such as EMI schemes, which are particularly useful. But in terms of your modeling, you need to be considering the other assistance that you'll need in your business, even if it's simply admin staff, an office manager, all of those type of things. And finally, you need to consider measures for a successful running of your business. as a professional services firm, for myself at Dragon Argent, our measures will be vastly different to yours, and you guys will probably have all different measures yourself that tie into your long-term goals and your short-term objectives. For example, for Dragon Argent, we need to ensure that our staff have enough client-facing hours per day. We need to know pounds per hour per client and other little measures. And these measures aren't something that you can necessarily build a model around, but you need to be considering them when you are building your model to ensure that everything in your model is geared towards the overall goal and the vision of the business. So the next thing I'll move on to is which tools to use. And this is a very brief section because ultimately I still believe that Excel is the best tool out there to create a financial model. There's no one size fits all for every business, and you might see online that many programs have been developed, especially in the last couple of years as more cloud-based accountancy softwares such as Xero and QuickBooks have come to the fore. There's a number of products that have come along as add-ons to those, but none seem to be as easily manipulatable as what Excel can do. So our recommendation generally is to do the number crunching in Excel. And then when you're pitching to potential investors or even other stakeholders, such as managers of your business and other key leaders, you can transform the quite ugly output from Excel into a nicer looking pitch deck, something which illustrates things in a better way, tells more of a story, but the underlying figures and growth is very, very easily modeled on Excel, using all the formula that can come with that. There's nothing really that I've seen in any other product that Excel can't do, besides creating that neat output in a sort of PowerPoint or PDF type output, which can easily be done as a secondary objective from Excel. So our recommendation is always to start with Excel. You want to be considering initially where the business is at today and its short-term history. If there's repetitive costs, then of course they need to be built into the model. But one of the most difficult things that you might have to consider is how is your business going to change in the next few months? There's no point in looking at the next 6 months and modeling that just by regurgitating the last 6 months, because presumably you would want to make development within your business. You don't necessarily want the next 6 months to mirror the prior 6 months. So you've got to ensure that although today and the short-term history is a starting point, you're considering exactly what will be required in the short term in order to take your product and your business into the next level. And again, Excel can do this in line with using Xero or QuickBooks. Xero is very good at recording recent history and reporting on that, and that can provide the basis to ensure that your future looking model is fairly credible in terms of what's happened in the past. So, as I mentioned earlier in this webinar, finance is only a small route to building enterprise value. And ultimately, for most people in business, I'm sure none of you would disagree, the aim of what you're trying to achieve is to build value. I'm sure a number of you have objectives. You'll probably work in the area of your business because you find it very interesting, or there's a problem to be solved in that area, or you particularly like sustainable development and you can see ways of doing this which will help the environment. And there's all sorts of reasons why people would go into business, but ultimately for 99% of businesses, the aim is to build value. That could be for several reasons. For example, a lot of people might have an early retirement objective. You want to build value in a company, you want to sell it, and you want to go and live abroad and spend your money in a much more relaxed way. You might want to build your company for the next 30 years, see how large you can take it. So what you've got to do as a business owner initially is ask yourself 10 fundamental questions of why you're in business and how you're going to build that enterprise value. So what you'll see on the screen now is fundamental questions of how you create the most value for yourself and your business. This will help you answer what are the key value drivers of a business. Some may be less relevant at the startup stage and where you are now. And as time moves on, different value drivers will become more and less important. But the reason that I bring this up today is that all of these things need to be considered when building a financial model. There's no point in building a financial model that doesn't really have any relevance to the objectives of the business. You've got to think about these fundamental questions and go through them individually, and it helps you understand the strengths and weaknesses you have as a business, and that will have a significant bearing on your financial model. As a random example out of this list, if we go down to question 4, and question 4 is split into 2 parts, but one of them asks, are we marketing our proposition effectively and efficiently? I would guess that every person in this webinar today thinks that they have a good value proposition, and most of you probably do. You've come through a university hub, which kind of ensures that the idea that you have has been pre-vetted by people who look into these things. So the chances are you have a good proposition. However, if you're not marketing your proposition effectively, then no one's going to know about it to ultimately buy it. It'll struggle to gain traction. So these questions here are questions that you need to be considering to understand where your strengths and weaknesses lie as a business. And that, like I say, really does feed into the financial model. It'll understand potentially where you need to spend money in the short and medium term to ensure that all of the drivers of growth are addressed as soon as possible. The top of this screen here mentions the compounding of growth drivers. This basically just alludes to the fact that the earlier that you can identify the drivers of your growth, the more that growth can compound. There's no point in identifying these drivers 6 months down the line, because you've then lost 6 months of growth, and 6 months of growth will vastly improve your growth in the following 6 months. So it's something that should be considered at the earliest stage to understand the drivers of your enterprise value. One other thing that's touched on this screen is the Pareto principle, which, if any of you have ever done any sort of business strategy courses in the past or economics, will probably have come across this before. But it's the concept that 80% of inputs affect 20% of causes, which create 80% of outcomes. And in a mindset relating that to your business, what that means is you probably want to spend 80% of your resource on the most important 20% of things. So it's important to look objectively at your business, take a step back, analyze it, looking from above rather than being stuck in the weeds, to try and understand what are your 20% of things that derive 80% of the growth, in order to make sure that you can proactively manage things that genuinely are important to your business. One of the things I see again, time and time again, that clients fall foul of is things such as just doing too much admin. As opposed to hiring a cheap admin assistant, they'll spend hours doing things that aren't really adding to the value of their business, rather than focusing on the key 80% of things which will generate the improvement in the business. So these 10 fundamental questions, I think, is a bit of an exercise of proactivity, prioritization, and focus. You need to ensure that you're hitting objectives across not only finance, but business development, marketing, delivery. You've got an effective strategy, you've got good people assisting your business. And that doesn't necessarily mean you need to hire people, but just a network of people that are around you that may have gone through similar situations. Just maintaining a network between you guys all in this group now will probably derive value to your own business, because you'll all come up against things that each one of you will have already come up against, and your experiences will help each other. I think business and starting out as an entrepreneur can be a lonely place, and it's very important to ensure that the right people are around you to add a skill set to your business, to bounce ideas off, and ultimately to do various things that you're less good at. You're all going to be very high ability individuals in your sphere, but that doesn't necessarily mean, for example, that you're great at financial modeling. So a lot of the time, that this touches on question 7 on the screen now, a lot of the time you'll need to ensure you've got the right people around you to make sure that you're ticking all the requirements of growing a business, as opposed to just trying to do everything for yourself, because that can just become a bit of a nightmare, I think. And it's something we see time and time again, entrepreneurs struggling to relinquish a little bit of control just to ensure they get the right skill sets within the business. So the next slide shows what we believe to be the key drivers of enterprise value. And as I touched on earlier, these are things that you need to be thinking about when you're creating your financial model. There's no use in creating a financial model that has no relevance to driving higher value of your business, because therefore the model isn't really doing what it should be setting out to achieve. So what we think the 10 key drivers of enterprise value on the screen now. And this is, I think, can be repeated across most businesses, to be honest. Each business is slightly different, but these are the ones that come up time and time again across all sectors, across all life cycles of business, whether that's the start of the business or moving towards an exit point. But things such as a mix of loyal clients, no clients being too responsible for your revenues. You don't want over-reliance on one single client. You want income security, and that means sort of recurring retained revenues, high probability repetitive income streams, as opposed to lumps of one-off income that can't really be predicted that well. Vitally, you need a value proposition, which means it's clear, compelling, and unique in your market. Generally, you have to be resolving an issue within the market to really take a business into the realms of people wanting to invest into it. As I said earlier, I'm sure all of you believe that you've got a value proposition which is sellable, and I'm sure the majority of you do. But alongside that, you need to have sales and marketing processes in place. This one is potentially one more for the medium term, but again, when you're considering a financial model, you'll want to be thinking about how much you might need to spend on this sales and marketing a year down the line. And that means that you need someone who understands effective and scalable business development processes. For example, lead generation, qualification of those leads, conversion of those leads. And then once those leads are converted, account management, account development to ensure that those clients become a source of secure income in the future. Owner reliance is a key one, which quite often isn't considered by entrepreneurs. It's not always a good thing for the value of a business to be reliant on an owner. What an investor or a potential buyer would want when buying a business is buying a business that can operate outside of that original entrepreneur or owner. What they don't want is a business where the relationships are so tied into the owner that if the owner leaves, the business would die. So sort of, as I said, relinquishing that control can be difficult initially for an entrepreneur, but by creating a good management team of highly capable, engaged, incentivized staff that can run the business in the absence of an owner, it creates such a more well-rounded business that becomes such a bigger proposition for an investor or a potential purchaser further down the line. Not least because often owners and shareholders could look to exit the business post-sale. So any potential buyer would see that as a bit of a red flag if there's a high level of owner reliance. Management information is up here too. And that can involve the financial modeling that we've mentioned, anything from historic reporting to current reporting. And this just means we need high quality, accurate data. For example, further down the line, sales and profitability by product and by service, by client. And this is data that not only should be created, but also used to inform business decisions. Knowing exactly where your profits and revenues are derived from will help you derive better profits and revenues in the future. So you need good, accurate data on your business's finances. We've touched on objectives already and how SMART strategy, SMART standing for specific, measurable, accurate, realistic, and timely. Creating objectives which fit those adjectives to fit into the long-term strategy of the business, again, is a key driver of value, simply because if you don't have objectives and goals, then you will really struggle to articulate to a potential investor why they should be investing in the business, what's in it for them, where the business is going in the future. Profits are obviously important. Again, this is probably more of a long-term consideration, but investors are going to, as I said earlier, want to know where their return will come from for their investment, and that will mostly be derived by profit. And finally, potential buyers is a key driver of value, and that's something that we'll touch on more tomorrow. But if there's a strong pool of unconflicted potential buyers who can afford to buy or afford to invest in your business, then that gives even more compelling reasons for the buyers to buy into all of the other drivers. If you have no potential buyers, then it's likely a sign that you're not ticking all the boxes elsewhere, or potentially that the value proposition just isn't quite as compelling as what you think it might be. But buyers will only come if you've got these other areas in place, such as the financial modeling, which sort of tell the story of the business, both currently and into the future. The next section I just want to go into, I've touched upon these areas already, but this hexagon is quite a useful little diagram to consider exactly what you should be considering in your business at all times, and really digging down into each section of the hexagon. All of these things feed into your vision and objectives, and if one area of this hexagon fails, it becomes very difficult to achieve those visions and objectives. If you can't effectively manage your people or your finances or the delivery of your product or sell your product, then everything else sort of falls down around it. It's vitally important to consider all of these aspects of the business, and in the context of financial modeling, ensuring that you're allocating enough cost and spend and budget and human resource into all these areas to make sure that each section complements each other. It's slightly a case of the business will only be as good as its weakest area. And if the finances of the business can't support the people, or the people can't support the business development, then you're only going to be as strong as your weakest area. So this hexagon is something that you should, I would say, definitely take a note of and have front of mind when you're considering preparing your financial model. Common pitfalls that we see, frankly, I would say the main one is a lack of consideration. Creating a model, I don't think, is particularly difficult. You all know your businesses very well. You hopefully can answer the questions that we've touched upon earlier in this webinar with regards to what the fundamental drivers of your business are. And once you can answer those questions, then you can build a model around it. What we often see, though, as I said earlier, is entrepreneurs getting stuck in quite meaningless tasks that could be admin related, or just not considering the bigger picture at all, and therefore losing the overall goal of what you set out in the business to achieve. It's very easy to get caught up in day-to-day operations, but time and again, you will need to take a step back, consider the bigger picture over a number of months or a year or two to really think what you need to put in place to ensure that the growth journey continues. When you're building a model, you will need to create assumptions. There's no value in having a model which simply states that you're going to generate 10 million of revenue in 2 years. Any investor would want to know how you've arrived at that 10 million. What is your market? What's your price? How much are you going to sell? All of these assumptions are quite simple, but do need to be thought through when creating a model. Investors don't necessarily expect a model to be accurate, especially when projecting into the future. There's no reason why your historic and current figures can't be accurate, because that's very easy to get a handle of. But your forecasts are just that. They're very difficult to predict with a high level of accuracy. So you don't need to worry about perfect accuracy. Plans change. Investors know that. As time moves on, information grows. You'll spend your money in different ways to what you initially suspected. But again, just having that initial consideration means that as you move down your business life cycle, you can learn from your previous projections. You can start to learn what is driving value in your business, where money has been spent well, where it's been wasted. You can compare monthly actuals to your original budgets, and it just promotes wider strategy of business where you have a constant learning curve in terms of knowing what adds to your business value. It'll help you derive where weaknesses are in your business. And to me, it's just that consideration of the bigger picture is definitely the largest pitfall that we have. Another pitfall we see is hello.
Can I jump in quickly? Because
Yes.
one of the feedbacks that we often get from the entrepreneurs, especially when you're talking about assumptions, is in the early stages of what should they, because as you're saying, investors will understand that you can't make perfect estimates, but to ensure that it's not completely guesswork, I guess.
Yeah.
So what assumptions or what should they base their assumptions on, what to take into consideration to still give as an accurate picture as possible. If you could give some more practical examples of this.
Yeah, so what you've touched on there is actually something which I come into in quite a lot of detail tomorrow. I think the majority of people on today's webinar are also on tomorrow's as well. And if not, I can share the slides from that. But in terms of the assumptions to build into the original model, that's one of the key areas of tomorrow's webinar. So it's okay if I'll sort of address that more in that section rather than going into too much detail now, as I'll sort of just end up repeating myself tomorrow, if that's okay.
Yeah, absolutely.
Perfect. So yeah, one of the pitfalls, as I said, lack of consideration and a lack of external input. Again, a theme I've touched on quite a lot during this webinar. You will need other people to help along the way in your business. And having, for example, an accountant periodically look over your finances. And this doesn't need to be day to day, but at least quarterly, just to ensure that assumptions that you created tie in with each other, the whole story sort of fits what you're trying to project to the investors. I think is always a very sensible thing to do. You want to spend money on your business to enhance the skill set within the business, because ultimately it frees up your time to do what you're good at. I personally don't see a great deal of value in you guys getting too bogged down in your own financial projections when you could outsource that. You can outsource your day-to-day accountancy and admin to different people. And ultimately that will free up your time to do what you do best. And that what you do best is the highest value driver of growth, which you'll have in your business. So I think lack of external input and lack of consideration are the two most common pitfalls that we see. And as Hannah just asked, tomorrow I'll go into sort of more specifics on exactly what you might consider when going into your initial financial model, and to avoid falling into pitfalls there too. So just to quickly recap before we move into a little Q&A, if anyone wants to do that. Financial planning is very important. I personally think the most important part of it is related to cash, and managing your cash, knowing where you're going to spend your cash and making sure you don't run out. What you want to do is ensure within your model that you have milestones that you want to hit along the way in your business to deliver short-term valuation increases, which may just enable you to access further cash at more minimal dilution. No one can really grow a business standing still. You can put your own blood, sweat and tears and efforts into it, but if you don't effectively manage your cash and what you're doing with that, it'll be very difficult to quickly grow the business. The bigger picture of the financial planning, though, has to be ensuring you're dealing with your medium and long-term enterprise value growth. Again, this comes back to the 10 key questions we asked earlier. What is it that you need to achieve to really grow your business? What are your strengths? What are your weaknesses? And making sure that your model really ties into those. And it's not just a model for the sake of a model, it's a model to address strengths, weaknesses, opportunities and threats, and really understanding the drivers of value for your business. Time is finite and you're going to have to allocate resources into those value drivers, whether that be improving your people, whether it be improving your cash reserves or your ability to market your product or just the development of your product. It's just vitally important to understand exactly what you need to do to create a well-rounded business that is sellable to either clients or investors, or ultimately someone who might want to buy out your business. So for me, if there's one thing to take away from today's session, it's don't just create a model for the sake of a model. Don't sit in front of an Excel sheet and just start to project where costs might be. Kind of approach it in a back to front way, where you think, where do you want to get to in 3 years? Where do you need to get to in a year to achieve that? And then break it down into how you need to spend your money, where you need to get that money from, and how you allocate the funds, how long it's going to last, and all that sort of stuff. So for me, it's a back to front way. Get your goals in line, get your short-term objectives in line, and then your model should be derived from that, as opposed to simply sitting down and creating a model with no real consideration of what the end point is. And that's all I have for today. So thanks all for listening. I realise that's sort of been an hour of mostly me just talking at you. If any of you have any questions, then feel free to fire away now. Alternatively, Hannah will send around a recording of the session and the slide deck and include my email address. So if there's something you want to come back to me on, then feel free. That goes for not only the accountancy and what we discussed today, but obviously at the start of the session, we discussed everything that Dragon Argent can help with. We've had a number of calls booked in from people through Enterprise Hub and other networks to discuss anything within accountancy, legal, employment, HR. We're always very happy to give up half an hour of our time just to give some straightforward free advice just to build our networks. So if there's anything that you think we can help with, do feel free to get in touch directly with me or through Hannah, and we'll always be happy to help you on your journey. But in the short term, if anyone's got any questions on what I've discussed today, then please feel free to fire away.
Doesn't seem like there are any questions, but just to reiterate what Craig was saying, so there are one-to-ones that we have set up together with Dragon Argent, and that will be coming up in March as well. So that is what Craig was talking about, an opportunity to speak one-to-one for 30 minutes. Then you can have a bit more specific questions on your company. Again, the session tomorrow will then touch upon engaging with investors and a few practical examples of looking at how you kind of feed into the financial model at an earlier stage. I'm also going to be following up shortly with an email with this recording, with the slides, and there is a cheeky little anonymous survey that I would be extremely thankful if you could fill out. We're always looking to improve and put on as informative and helpful workshops and activities as possible. We're doing this for you, so it's really important that you get as much out of this as possible. So please do fill that survey out. So yeah, that's everything from me. If anyone has any questions for Craig, do ask so now. Otherwise, yeah, Milan.
Well, hi, Craig, that was really useful. Thank you very much. Maybe it's more of a comment, but I guess you touched on a very key point about us founders getting bogged down into details. And I think it's worth saying, I speak for myself, but maybe it's the case with most of the fellows. You know, many of us are engineers at the end of the day, techies, designers, scientists, et cetera, et cetera. So it means we get very focused on the technology, the technological development. And in my particular case, it's somebody else, my other partner, who looks a lot of the finances, but there's a big disconnect between the way this other person who comes from a business finance background sees the world and the world I see it, because the reality on the ground tends to be quite different than the reality on spreadsheets and so on. So yeah, I mean, I guess it's a pretty open question, but how do you address that gap? Because it's very easy to really sit down and say, yeah, I'm going to sell X number of units and spend this and that. And then when you're actually on the ground doing stuff, the world is so completely different than all these projections you had. So there's no easy answer. I'm just kind of sharing it because it's a bit of a frustration that we've had, that every single time we do a financial model, it's completely blown away by reality, in other words. And the pandemic made it even worse, actually. So
yeah, absolutely. And to be honest, we deal with a lot of tech clients. A lot of our clients are in software development, which have very similar issues to what you just said. And I think one of the first things I said today is, whatever you model, things tend to take longer to put into place than what is originally perceived. I think, as I mentioned, there's so many things that investors are looking for, and one of those is the credibility of your product and the development of your product. Revenue generation isn't necessarily the be all and end all. Taking your product from checkpoint to checkpoint will add value to the business. Even if it's not getting to the revenue generation point, it should enable you to access further investment if you are just keeping the growth journey alive, taking it from one stage to another, and then ultimately taking it into being a commercially viable product. If you set out initially to make it commercially viable in a year and it's taken 2 or 3, I don't think that's the end of the world. It's completely normal, so long as development is being made and you sort of have your development and IP protected along the way, then it ensures that there is value growth. It's just not necessarily coming from revenue at that particular point. But yeah, it's a very common issue and no doubt a source of frustration for a lot of people.
Yeah, thanks.
Can I ask a follow-up on that? Because obviously, if the revenue takes a bit longer than intended, it might be that the entrepreneurs and the companies have to go out for another round of fundraising or a bridge round or similar that they might not have planned to do. So kind of how do you mitigate those risks, and how do you, at what point do you have to kind of restructure that thinking and come up with that plan B?
I think the answer to that is as soon as possible, and having a financial model in place to do that is fairly key. So it's a very common issue. I've got a tech development client at the moment that has not given enough impetus into actually monitoring where their cash is going. They had investment of around 2 million at this time last year. That was meant to take them to the point where they'd be revenue generating and self-sufficient. It hasn't. The 2 million was meant to last them all throughout 2021. However, they probably spent 3 or 3.5, and they've got to a point now where they owe a software development company in the Ukraine about £1 million. They owe HMRC about 500,000, and now they need to get more investment. Their original investors are coming to them saying, well, what developments have you made in the last year? And actually, they have made really good developments in the last year. So they can show actually what they've spent the money on has been very useful, and it has taken them to the next stage. It's not quite taken them to revenue generation, but they have definitely developed their product in a very good way. The trouble side of that is my client's now in a terrible negotiation position because they need money as soon as possible. So they are now really struggling not to give away quite a large percentage of the business, because simply if they don't do that, then they'll go bust. So it's having that model in place initially, sticking to your budgeted spend. In my client's case, what was happening was there was 2 or 3 very highly paid individuals, which all had some responsibility for different areas of the business, but no one was putting any cost control over them. They were just spending month by month, overspending, not considering that their cash runway was to take them to around August, September. and they just completely blew it. Basically, they're going to get out of it. They've got investment in the next couple of months, which will see them through, but it's put them in a very stressful and awkward position in terms of negotiating that bridging round. So I think in answer to your question, just don't run yourself down the alley of having no money. Do sort of plan ahead. Bridging rounds aren't uncommon, but having a bridging round is fine. But when you approach it from a level of desperation, that's when you're not going to be in a good position to do it.
Craig, I don't know, Ben, were you going to ask a question? I don't want to jump in ahead of you. Cool. Craig, just on that last point, which is like the nightmare scenario, good luck to them on investors not turning their back on them. But do you make a recommendation on a cash buffer baseline, cash in the bank before emergency measures are taken? So in the case of that company, it might have been to sack a couple of those guys or girls who are overpaid, you know. So what is it, 100k, 200k, or do you look on it as more as a runway thing?
I would always look at it more as a runway sort of thing, because it's completely dependent on the speed at which you're spending the cash, and completely dependent also on how easily you think you can raise the cash again if you need to. What I would say is you don't want to have too much cash, which might sound odd initially, but what you don't want to do is get over invested early on, because your initial valuation presumably is going to be the lowest valuation that your company will ever have. So you'll be giving away the highest percentage for the initial cash injection. So what?
Yeah, sorry, carry on.
So what I was going to say is, what you don't want to do is sort of fund your company for the next 3 years, because you're unnecessarily giving away too much of your business then, because you don't need 3 years of cash in your business immediately. But what you do need to do is understand where your next checkpoint might be, and think about how much money you need to get to that checkpoint, and then build in a sensible buffer from that.
I have a follow-up question, Craig, on that good counsel. How then, or what mechanisms are there to avoid cliff edges then? If you run lean, I get that, because of the value for money, value for the equity that you sell. But you're always then balancing that with the risk of cliff edges, which puts the power with the investor. So what you saved up front, you then lose later on, because you're on the cliff edge. You don't want to fire your team. You don't want to lose that IP locked up in their heads. What's your thing? Because for me, that's a balance, isn't it? Yeah, you save a bit at the front end, but you lose it at the back end, because all of the power goes to the investor, because you're chasing investment.
Yeah, I think the answer to that would be similar to the answer I gave to Hannah. It's just having enough foresight to know that you're not going to run yourself that close to the cliff edge. If you took in, say, 300,000 of investment now and thought that'll last for months, and then never really give it any consideration and start spending it, you're much more likely to run to that cliff edge. If you take in 300,000 now and think, okay, this will be 30,000 for the next 10 months, and then you have a model, you know when you're going to spend it, and you can sort of look at your model month by month, know if you've overspent or know if you're on track, then I would say after about 5 or 6 months, then you would know if you're making the progress that you know you need to. After 6 months, say, on that 30,000 burn rate, you would have around 120,000 left. At that point, you can start looking for extra investment. You can start slightly cutting costs where you think they're not working, and just having that sort of foresight to monitor it and look forward on a regular, maybe monthly basis, would make sure that you don't just run yourself off that cliff edge, because you see it coming from far enough away that you can do something about it. As I said at the end of the workshop, the biggest pitfall is lack of consideration. And I think the cliff edge comes into play where there is a lack of consideration. I think if you have a model that you look at every month, you look at your cash burn, you know the liabilities that you've got, then as long as you make enough effort in that, you would struggle to completely run yourself down that sort of black hole.
There's one other thing I'd add, Craig. It's great advice, but one other point I'd add is looking for cliff edges that the investors are close to, like tax events and things like that. So,
yeah, absolutely.
If you could time those value inflection points that you speak about to coincide with tax events either here or the US or wherever the investor is, then you can kind of switch the power around a little bit.
Yeah, you're completely right. And the first little section of tomorrow's webinar is about sort of understanding the growth opportunity that exists, which comes around from these investors' tax events under EIS and SEIS. And if you can maximize those, then, like you say, you'll maximize the value. So it's a good point.
Cool. Great, thank you. Great call. Really looking forward to tomorrow, actually, Craig.
Good to hear.
That'll be the meat of it, I think.
Anyone else that sits on a question? I know some of you might have to leave if you have other engagements, but otherwise, hopefully you'll join us tomorrow as well, as Craig has already teased a few topics that we will be talking about. So I think that will be very helpful. And otherwise, keep an eye out for the email. It should be coming through in the next few minutes. I just need to download the recording. But yeah, I hope you've enjoyed it, and I look forward to seeing you all tomorrow.
Thanks, guys, and hope to see you all tomorrow.